Hey everyone, today we're diving into a topic that's been making some serious waves in the financial world. Bank of America has just dropped a bombshell of a forecast, and it's got everyone from seasoned investors to curious onlookers talking. They're predicting gold could hit an eye-watering $5,000 an ounce by 2026, and silver could soar to $65. Now, that's a bold call, to say the least. So, what's behind this prediction? Is it just a wild guess, or is there some solid reasoning backing it up? Let's break it down piece by piece and explore what this could mean for the global economy and for your own financial strategy. First, let's set the stage. Gold and silver have always been seen as safe haven assets. When the world feels uncertain, when stocks are volatile, and when inflation is eating away at the value of our cash, investors often turn to precious metals. They're tangible, they have a history spanning thousands of years, and they can't just be printed out of thin air like currency. This fundamental quality is at the heart of Bank of America's forecast. So the big question is, what specific factors are they seeing that could push prices this high? And one of the primary drivers is the expectation of continued or even accelerating inflation. We've all felt the pinch at the grocery store and the gas pump. Central banks around the world, including the U.S. Federal Reserve, printed unprecedented amounts of money to stimulate economies during recent global crises. While this might have helped in the short term, it also diluted the value of currencies. Think of it like this. If you have more dollars chasing the same amount of goods, the price of those goods goes up. That's inflation. Bank of America seems to believe that this inflationary pressure isn't going away anytime soon. If they're right, holding assets like gold and silver becomes a very attractive way to protect your purchasing power. As the dollar buys less, the dollar price of gold and silver would naturally rise. Next up is geopolitical instability. Let's be honest, the world feels more on edge now than it has in a long time. We have ongoing conflicts, shifting global alliances, and a general sense of unpredictability. During times of geopolitical stress, investors get nervous. They start looking for stability, for something that's not tied to the fate of a single country or political system. Gold has always been that asset. It's universally recognized and valued. If global tensions continue to simmer or escalate, the flight to safety could turn into a stampede, driving massive amounts of capital into the gold market and pushing prices up. Another huge factor is the behavior of central banks themselves. It's not just individual investors buying gold. Central banks are some of the biggest players in the market. In recent years, we've seen a clear trend of central banks, particularly in emerging economies, stockpiling gold reserves. Why? They're trying to diversify away from the US dollar. For decades, the dollar has been the world's primary reserve currency, but many countries are growing wary of being so dependent on it. By buying gold, they're hedging their bets and adding a layer of stability to their national wealth. This consistent large-scale buying from central banks creates a strong floor for the gold price and provides a powerful, steady tailwind. If this trend continues, as Bank of America likely expects, it will be a major catalyst for higher prices. Now, let's talk about the US dollar and interest rates. The relationship here is crucial. Typically, when the Federal Reserve raises interest rates, it makes the dollar stronger. A stronger dollar makes gold, which is priced in dollars, more expensive for foreign buyers, often putting downward pressure on its price. However, the market is now anticipating that the Fed will have to start cutting interest rates in the near future to avoid a major economic slowdown. When interest rates fall, holding cash or bonds becomes less attractive and the dollar may weaken. This is a very bullish scenario for gold. A weaker dollar makes gold cheaper for international investors, and lower interest rates reduce the opportunity cost of holding a non-yielding asset like gold. Bank of America's forecast is likely banking on this pivot from the Fed happening sooner rather than later. So we have inflation, geopolitical risk, central bank buying, and the prospect of falling interest rates. That's a powerful cocktail for gold. But what about silver? Why $65? Silver is often called gold's little brother, and its price tends to move in the same direction as gold, but often with more volatility. It also has a dual identity. Like gold, it's a monetary metal and a safe haven asset. But unlike gold, silver has massive industrial demand. Think about it. Silver is a critical component in so many modern technologies. It's in your smartphone, your laptop, and the solar panels that are powering the green energy revolution. It's used in electric vehicles, 5G technology, and countless medical applications. This industrial demand is set to explode. As the world transitions towards cleaner energy and more advanced electronics, the need for silver is only going to grow. This is where things get really interesting. For years, there has been a looming supply deficit in the silver market. That means we are consuming more silver than we are mining. This deficit is projected to get even larger in the coming years as industrial demand ramps up. When demand outstrips supply, prices have to go up. It's basic economics. So, Bank of America's $65 silver forecast isn't just about it riding gold's coattails. It's also based on this incredibly strong fundamental story of skyrocketing industrial demand meeting a constrained supply. When you combine that with the monetary demand from investors seeking a safe haven, you have a recipe for a potential price explosion. The gold to silver ratio, which tracks how many ounces of silver it takes to buy 1 ounce of gold, is currently at a historically high level. A return to the historical average would imply that silver has a lot more room to run compared to gold. Of course, no forecast is a guarantee. This is a prediction, not a certainty. There are always risks. What if inflation gets under control faster than expected? What if geopolitical tensions ease? What if central banks suddenly slow down their gold purchases? Any of these could put a damper on the precious metals rally. The global economy is a complex machine, and things can change quickly. It's also important to remember that markets can be irrational and prices can be volatile in the short term. Investing always involves risk, and it's crucial to do your own research and understand your own risk tolerance before making any decisions. However, the case that Bank of America is laying out is compelling. It's not just based on one single factor, but on a convergence of powerful macroeconomic, geopolitical, and industrial trends. The potential for $5,000 gold and $65 silver by 2026 highlights a growing belief that we are entering a new financial era, one where the value of hard assets becomes increasingly important. So, what does this mean for you? It's a reminder to pay attention to the bigger picture. Whether you're an experienced investor or just starting out, understanding these trends is key. It might be a good time to review your own portfolio and consider if you have enough exposure to assets that can protect you from inflation and uncertainty. This doesn't mean you should run out and put all your savings into gold and silver. Diversification is always the golden rule. But it does suggest that precious metals could play an increasingly vital role in a well-balanced investment strategy over the next few years. This forecast from a major institution like Bank of America is a significant signal. It tells us that these ideas are moving from the fringe to the mainstream. We're talking about a potential major shift in the financial landscape. It will be fascinating to watch how this plays out over the next couple of years. Will they be right? Only time will tell. But the arguments they've presented are definitely worth considering. Thanks for tuning in today. I hope this breakdown gave you some valuable insights and food for thought. What do you think about this prediction? Is $5,000 gold a realistic target? Let me know your thoughts in the comments below. Don't forget to like this video if you found it helpful and subscribe to the channel for more deep dives into the financial topics that matter. See you in the next one.